In previous videos, we discussed what an income statement is and why it's a useful tool in evaluating a firm's performance. But we kind of need to discuss this other part, that there are some limitations to using an income statement. It's not a perfect measure of a firm's operations, and there's some important reasons why. So first off, an income statement does not measure everything that is going on at the firm. There are a lot of things that are not captured in an income statement. Now, it might be tempting to look at an income statement. Some of them are very long. They have a lot of line items, but it does not get everything. So let me just give an example. So let's say that you had invested some money in, you're running some advertising on TV, and you think that, okay, this is going to have an increase in our brand value. And for some companies, this is very, very important. When you think of a company like Coca-Cola, brand value, the value of the Coca-Cola brand and trademark, that might be the most important thing in their entire firm, is that brand that people identify with. But an increase in brand value is not recorded. And in matter of fact, when you spend money on advertising, let's just go to a basic income statement here. That advertising expense is gonna end up down here, either in SG&A or it'll be its own line item. But that's an expense, so that's actually going to decrease your profitability, not increase it. So you might say, okay, well, wait a minute. But when we spend money on advertising, we're going to ultimately increase this thing right here, the revenue. Okay, well, that's fair. But maybe that will take a while. Maybe you're just increasing loyalty among someone by spending this advertising. Maybe 5 years from now, they will not change to another brand because they're loyal. So in any event, the important thing to remember is that we've spent money and maybe we have increased the brand value and we have increased the net worth of the firm, but it's not recorded. It's not going to show up in the income statement in any way, shape, or form necessarily. And maybe never, or maybe it'll be a few years before it somehow maps into revenue, but it's not in there. So there are a lot of things like that are just simply not recorded in the income statement. So another thing to think about is that there are differing methods used by firms. Now, this isn't any kind of necessarily sleight of hand or anything on the part of firms. They're just different reasons why a certain firm might choose to use a certain type of method. For example, in the construction industry, we have two completely acceptable ways of accounting for construction activity. One is you have the completed contract method, and then you also have the percentage of completion method. So both of these methods, these lead to very different results. So when you look at one firm, say firm A uses completed contract, and then firm B uses percentage of completion, well, we can't really look at each of their income statements and get an idea of in terms of the comparability of what's going on with A relative to B. We can't really benchmark them in certain ways. We might get a really different idea of what's going on at this firm if we assume that it's using the same methods as firm B. So firms have the right to use different methods for certain types of some activities, or it be construction or some, or even depreciation methods. And so because of that, the income statement, we can't just look at one income statement and look at another and just say, okay, well, these two firms have this type of net income and therefore we can draw this conclusion. We have to take into consideration these different methods that these firms use. So another thing to think about is the use of estimates. So managers have considerable leeway with certain types of, not all items, but certain types of items. There's a lot of manager discretion. For example, let's take the notion of depreciation. So while a firm has to use certain types of methods for depreciation, most firms use either straight line depreciation, double declining balance, and so forth, there's the idea that, well, managers can go ahead and say, well, what's the useful life? Maybe they determine that the useful life is 10 years instead of 5. Well, why is that? Well, that's just their opinion. Now, they might base that on previous things. Maybe they say, okay, well, we have this other asset and it lasted 5 years, so we think this one will last 5 years. Okay, that's fine, but it's still an estimate. And a manager at another firm, at firm B, might say, I don't agree with that. I'm going to use this other estimate. And then like the salvage value is another thing that they have. So there's a lot of discretion. And when you think of something like deferred tax asset valuation allowance. I mean, something like that is almost like a manager pulling a number out of thin air. So we have all these estimates, and then, so these aren't necessarily bad things. I mean, a manager might abuse the estimate idea and make some really generous estimates that go in his favor or her favor. But here's something that this maybe is, some people see as a little more devious, and this is something called earnings management. So managers can kind of use the discretion that they have, not just in making estimates or choosing methods, but also in timing gains and losses. For example, they have some kind of unrealized gain, or loss or something. They say, well, you know what, we don't want to take that this period. We want it to go into next period. So let's go to our sample income statement again. So they might have maybe they had some unrealized gains or something, and they decided to sell them in this period to get this to be 30, but maybe otherwise, maybe it would have been 24, and they were having a bad period. And they said, well, we've got some unrealized gains, and we're going to go ahead and we're going to sell those. Or maybe there's some kind of estimate, going back to the estimates and how it could potentially be abused. Well, maybe they say, well, we're going to estimate, we're going to overestimate in one period some kind of expense that we're supposed to estimate. We're going to overestimate, and then we know that we're estimating too much, but then in a future period, then we can go ahead and record less, and it'll offset. And so that's where you hear the term cookie jar reserves. We'll take too much of a loss now in this estimate, and then later we can reduce it and say, oh, we took too much last period, and go ahead and reduce it. We create a cookie jar of reserves. So in any event, I'm going to make, we'll have other videos to kind of discuss more in depth how firms do that. But suffice it to say for right now that this number here, this net income number, is subject to considerable discretion in terms of that it doesn't include all the items or all the activity that's going on in terms of like brand value. The manager can choose all different kinds of methods, and two different firms might have two completely different ways of accounting for the same thing. The manager has all kinds of leeway in determining what kind of discretion he wants to or she wants to use for useful life of things or these other estimates. And then we've got this earnings management portion where you can actually have the manager, he or she, timing gains or losses in order to kind of manipulate this number. And a lot of these things, almost everything I've talked about here is perfectly legal. These things are all legal, and there's nothing crazy here about managers making estimates or managers doing this earnings management. It's a very common thing. But it's something we need to recognize that when we look at this net income number, there's a lot of different things that go into it, and we just can't take this number as being perfect.